Hey, Brian.
Hey,
Hey. So I got a fun one for you today on
hit me.
things that matter with Brian Batter. I want to start by saying you are undeniably the smartest person when it comes to all things Wall Street. So no better question to ask you. And I'm Italian, so I relate everything to food. What the
Okay.
fork is going on with Wall Street? Can we just what is their deal? What
Yeah.
is it?
Okay. Well, first, let me say we might got to expand your friends because if I'm the one person who knows the most, we got to know more people. But that being said, I've been at this now nearly 20 years in the industry, and I've come to understand really what Wall Street's game is. And it bottom line boils down to three simple letters called AUM, and it stands for assets, that's money, dollars, under management. And that's if you talk to anybody who's in the business, like, how big's your book? How big's your book? That means how many dollars they have under management. Because Wall Street's game, and I'm talking about, an advisor at any of the wirehouses, Morgan Stanley, Merrill Lynch, Goldman Sachs. Then you have the other companies like LPL, Ameriprise. There's thousands of broker dealers in the industry. We'll focus on what their game is. Their game is getting more money under management, charging what's called an advisor fee. And that typically will go somewhere between, 0.5%, 1.5%. And that's charged directly from the client's account. So the client would see a fee taken out typically every quarter. So if you're getting charged 1%, that means every quarter, every 3 months, you're seeing 0.25% of your money taken away from your account to pay the advisor. Okay, and that's fair because people need to eat. They got to feed their families. We understand that. Now, what tends to happen by and large, though, is that the advisor isn't curating an artisanal portfolio of individually hand-selected stocks, right? It's not a charcuterie board. You know what I mean? What they tend to do most of the time is take the money the client gives them and they spread it out. That word is called diversify into different mutual funds or exchange traded funds or possibly a handful of stocks. But by and large, you're going to see most people's money placed into mutual funds. So you're familiar with mutual fund companies, right? You probably think of a couple of them like, T. Rowe Price or Fidelity. And they're good companies. They're good people that work at these companies. But they don't work for free, right? So when we give our money to a mutual fund company, those funds have what's called operating expenses. And they charge that because the people running that fund, managing the strategy, well, they have to do research on like which companies or which bonds to invest in within that fund and its strategy. So what happens to the client is they're getting charged the advisory fee paid to the advisor whose name is on the account, and they're getting charged the operating expense of the mutual funds that the advisor has put their money in. So you have two sets of fees. Now, the fundamental reality is that Wall Street, the advisors are looking to find bigger and bigger clients. They want the biggest clients they can get because you charge them 0.5% of 1% of $20 million. That's more than 1% of $500,000, right? Now, here's the silly way to look at it. Imagine you're an advisor, right? So you run Calabrese Management and you've got 200 clients in your boutique. Your biggest client's $20 million. Your smallest client's $500,000. You wake up in the morning early and you see that something funky happened in Asia and the markets look like they're going down. The futures are going down. You're like, oh my gosh, I need to do something for my clients. Now, you have 200 clients. Your biggest one's 20 million. Your smallest one's 500,000. Which account are you going to focus on first, Paula?
The 20 million, the biggest one, because it makes me the most amount of money.
Right. I mean, naturally. Now, in reality, you want to help everybody, but that's just unrealistic, unfortunately. And so what tends to happen is they go after protecting their biggest client because the thought process is if I protect my biggest client from major losses, maybe even we get him out before there's any losses, and her money's protected. And she goes to the country club this weekend to play golf, with her girlfriends, and they're all complaining about how much money they lost that week. if you're able to get one referral to another $20 million client, you could watch your bottom 40 clients who have $500,000 each with you. You could watch them walk in. You don't care at all because you just replaced $20 million spread out over 40 clients with one client who had $20 million. So your income didn't change. Frankly, you actually have more time now because if you had 200 clients before, now you only have 160, right? 40 of them left you. You have less to manage, less clients, but you have the same dollars under management because that's the game. Assets under management. Now, what does this mean for the other people? Well, typically, they're going to hear, like, when the markets drop, when the accounts are going, down, they're going to hear things like, well, hey, Paula, this is a long-term plan, right? We've got a couple of decades before you retire. We've got plenty of time in front of us, right? By the way, you're diversified. This side might have gone down, but over here, this side came up a little bit. And lastly, look, the market's down now. Remember that extra money you said you had over there? Now would be a good time to put it in and buy when things are low. Now, all those things are true. It is a long-term plan for you, usually. You are diversified, typically, because they put you in mutual funds, which have a bunch of different investments inside of them. Although there might be a lot of overlap, a lot of different funds invest in the same companies. That's a topic we'll discuss, I'm sure, in another conversation. And yeah, things are down, and you could be buying in when things are low. So none of those things are false. They're not, lying. They're not fraudulent. But the real question is that what they told their biggest client? And if it's not what they told their biggest client, they focus on getting their client out. They focus on protecting those assets because they want to make sure they don't, A, lose the client, and B, they increase the odds they get another referral to an equally sized client. If that's not what they're telling the client, then the real question is, well, what exactly are you paying them for? And again, Wall Street's game is assets under management. So I've always encouraged people. I'm not saying they're bad people at all. There's lots of great people in this industry. But the structure of the way compensation is generated, by and large, forces individuals, representatives to focus on high dollar clientele, big institutions, leaving the average person left holding the bag. And the average person still might have $300,000, $400,000, $500,000 in their retirement account, their IRA, their 401k. That's their whole life savings, but it's not really big enough to get Wall Street's attention. And so I always encourage people when they say, oh, I'm good, I got a guy. I'm like, that's great. Good. I'm glad you do, because most people don't. They only have their 800 number at their retirement plan from their job. Now, I always encourage them to ask 3 questions. Go call your advisor and ask 3 questions. Number 1, what exactly am I paying in fees? Right? Because usually, again, there's an advisory fee. You might see called WRAP, WRAP, or just advisor fee, on top of the mutual fund operating expenses. The mutual fund operating expenses, you might need to do a little bit of digging to figure out how much they're actually charging you. But what am I paying in fees? First question. And I always counsel people, when you ask that question, don't listen to the words they say. Listen to their tone of voice. Usually what happens is, I just want to know exactly, what am I paying in fees? In many cases, that person is going to get defensive right off the bat. What do you mean? Industry standard, 1%, 1.5%, 0.5%, right? It's whatever he charges. Pay attention to how they respond. So what am I paying? Number 1. Number 2, when the market drops, which it does, how does that fee protect me against either major losses or losses in general? What if I could protect this? Because there are solutions and strategies that people can use to give themselves peace of mind when the markets go down. So A, what am I paying a fee? B, how does that fee protect me and my beneficiary? God forbid I pass away prematurely. How does that protect them? How does that protect my money against loss? The fee I'm paying you. How does that protect me against loss? And the last one is, if this is a retirement account, the fee I'm charging you, the fee you're charging me, what kind of income guarantees does that fee provide me? I need this money to last me in retirement. I don't want to become a burden on my children, run out of money and say, hey, can I come move in with you? How does that fee guarantee me income throughout my retirement? Now, they might give you some strategies, which we'll address, I'm sure, in another conversation about how what their game is. But that's usually what it's assets under management. And the last thing I'll say about Wall Street's game is we hear this three-letter phrase called IPO, right? It's called initial public offering. And that just means, Paula, if you decide to start a company, it was privately owned, and you start to grow, and you get to the point where you're like, man, we could really expand, but we need capital. I don't have the money. The banks are, we've maxed out the loans we can get from the bank. I need to go to the capital markets. And that means you take your company from being privately owned by you and maybe whatever partners you had to start it. Now, instead of it being privately owned, you take it and you let the public own shares of it. That's what shares of stock mean. You're sharing ownership in the company with a bunch of other people. So now when you do that, you have to go to what's called an underwriter. You can't just take your company to the New York Stock Exchange and be like, hey, list me here. They're going to look at me like, who are you? All right. What company is this? So you go through an underwriter, and that might be a Morgan Stanley, Merrill Lynch, a Goldman Sachs, an investment bank, whatever it might be, Jefferies. There's a whole bunch of them. But what happens is they now have inventory of your company's stock. And they determine an initial price, and they'll go to certain institutions, certain private clients, say, hey, we can get you owners. You can buy into this before it actually goes public. And then once it does, what tends to happen now is if it, name the broker deal, name the company, they're going to immediately reach out to all of their licensed representatives and say, hey, we just brought this company public. We brought this IPO up. Call your clients and ask them if they want to buy in, because they've got, however many hundreds of millions of shares sitting on the shelf, right? They don't want to, when they brought Facebook public, they didn't want to own 300 million shares of Facebook, right? They want to get rid of it. They want to get it out of off of their shelves. It's inventory they don't want. So now all of a sudden, these advisors get the call or get the email or get the pressure. You got to, tell people about it, see if they want it. And so Wall Street's game is about getting more assets under management. There's great people in the industry, but unfortunately, too much of the way the industry is structured, it leaves a lot to be desired. And people do end up getting hurt. They end up losing money right when they need it most. And they're not really, they're not, frankly, they're not being shown alternatives to that model. It's great to grow money. If you're young, long-term, be aggressive. But when we get older and, we're closer to retiring and needing to generate income, unfortunately, many of Wall Street's strategies don't apply at that point. They're not able to do it. And so I love showing people that, just expressing this to people. Go ask your guy or your gal those 3 questions. What am I paying in fees? Pay attention to how they respond. Listen to their tone. What protection against market losses? How is that protecting my principal? That fee, I'm paying you something. Right. And the scary part is that most funds and most advisors never beat the market. They don't beat their benchmark, the S&P. So what are we paying them for? And then number 3 is that income guarantee, this fee I'm paying you. What guarantee? What happens when I retire? What guarantee of income can this provide me? We got to remember, dividends from stocks are not guaranteed. The company can decide to stop paying it. They might say laddered bonds, and we'll get into this in another conversation. But the challenge is, if you buy a laddered bond portfolio, and the Fed has to raise rates, well, the value of the bonds that you own just went down, which means you have less money to buy the next one, right? Unless you want to wait for it to mature, which might take too long, considering your time frame. So you're paying these fees. And here's a new word for the day. It's spelled Fwhat. You're paying these fees for what? That's all I got to say about that.
Food for thought. Thank you, Brian. You always, give us the best information and make me laugh at the same time. So I appreciate it. Thank you for simplifying and making this easy to understand and digest. And it's something to sit with. So thank you for being here.
You got it. Hey, if you can't have fun, you can't have anything.